Ever looked at a stock chart and felt completely lost? All those lines, bars, and colors can seem overwhelming, but they hold powerful clues about when to buy, sell, or hold a stock. Whether you're a beginner investor or a curious trader, understanding how to read stock charts is a must. We break down everything you need to know, from candlesticks and moving averages to support, resistance, and key indicators, so you can start making smarter, more confident financial decisions using technical analysis. Today we will talk about how to read stock charts for beginners, Technical Analysis 101. So before we start, make sure to hit the like button and subscribe to my channel. If you're new to investing or trading, learning how to read stock charts can feel overwhelming, like trying to decode a foreign language filled with confusing lines, shapes, numbers, and indicators. But understanding how to read stock charts is one of the most important skills you can develop if you want to become a confident and informed trader or investor. Stock charts aren't just for professional day traders. They offer valuable information about price trends, historical performance, market psychology, and potential entry or exit points. Whether you're buying your first stock or trying to time your next trade, this is your beginner-friendly deep dive into Technical Analysis 101. Let's start with the basics. What is a stock chart? At its core, a stock chart is a graphical representation of a stock's price over a specific period. It shows how the prices move over time and is often accompanied by trading volume, how many shares were bought and sold. Most stock charts can be customized to display different time frames, such as 1 day, 5 day, 1 month, 6 months, year-to-date, YTD, or even up to 10 years. They can also use different chart types, which we'll cover next. Stock charts are commonly found on financial platforms like Yahoo Finance, TradingView, Whipple, Thinkorswim, and your brokerage's mobile or desktop platform. There are three main types of stock charts: line charts, bar charts, and candlestick charts. Line charts are the simplest. They connect the closing prices over a set period using a single line. They're great for spotting general trends, but don't provide much detail. Bar charts add more information by showing the open, high, low, and close OELC prices for each period using vertical lines and small horizontal dashes. However, the most popular and informative type of chart is the candlestick chart, which originated in Japan centuries ago. Each candlestick represents a set time period, 1 day, 1 hour, 1 minute, and displays the opening, closing, high, and low prices. The body of the candle is colored green or white if the stock closed higher than it opened bullish, and red or black if it closed lower bearish. The thin lines, wicks or shadows, above and below the body represent the highest and lowest prices during that period. Understanding time frames is critical when reading stock charts. Different time frames tell different stories. A daily chart, 1D, shows each candle representing 1 day's price movement, which is good for swing traders and long-term investors. A 5-minute chart is used by day traders to capture quick intraday price moves. A weekly or monthly chart gives a longer-term perspective, which is helpful when analyzing trends that develop over months or years. Beginners should familiarize themselves with multiple timeframes. This is called multiple timeframe analysis to get a holistic view of a stock's behavior. One of the first concepts to grasp in technical analysis is the idea of support and resistance. Support is a price level where a stock tends to stop falling and may bounce back up because demand increases at that level. Resistance is the opposite. It's where a stock often stops rising because selling pressure kicks in. These levels can be identified by drawing horizontal lines on the chart where price has historically bounced or reversed. When a stock breaks through resistance, it may continue upward, a breakout. When it falls below support, it may drop further, a breakdown. Understanding support and resistance helps you plan entries, exits, and stop-loss levels. Next, let's talk about trend lines and chart patterns. A trend line is a diagonal line that connects either higher lows in an uptrend or lower highs in a downtrend. It helps visualize the overall direction of the price. Price rarely moves in a straight line, it moves in waves. Identifying whether the stock is in an uptrend, higher highs and higher lows, downtrend, lower highs and lower lows, or sideways trend, consolidation, is key to making informed decisions. Chart patterns like flags, pennants, head and shoulders, double tops, double bottoms, and triangles help traders predict potential reversals or continuations in the trend. These patterns are not guarantees but can provide a probabilistic edge when combined with volume and other signals. Volume is another critical indicator that should always be considered alongside price. Volume shows how many shares are being traded and indicates the strength of a price movement. For example, a breakout above resistance with high volume is more significant than one with low volume because it suggests strong participation by buyers. Many chart platforms plot volume as vertical bars below the price chart. Look for volume spikes. They often signal the start of a new trend or heavy institutional buying or selling. Now let's introduce some technical indicators. These are mathematical calculations based on price and volume data, and they help traders interpret chart patterns more effectively. Some of the most popular indicators include moving averages, MA. These smooth out price data to show the trend more clearly. A simple moving average, SMA, takes the average closing price over a set number of periods, EG, 50 or 200 days. Moving averages act as dynamic support and resistance levels and are used to confirm trend direction. Relative Strength Index, RSI. This momentum oscillator ranges from 0 to 100 and measures whether a stock is overbought, typically above 70, or oversold below 30. RSI helps identify potential reversals or pullbacks. MACD, Moving Average Convergence Divergence. This indicator uses two moving averages to detect momentum shifts. When the MACD line crosses above the signal line, it's considered bullish. When it crosses below, bearish. Bollinger Bands. These are volatility bands placed above and below a moving average. When price touches the upper band, it might be overbought. When it touches the lower band, oversold. It's important not to overload your chart with too many indicators. Most beginners benefit from learning to use 2 to 3 tools effectively rather than trying to interpret a dozen conflicting signals. Simplicity, consistency, and practice are key. One area where beginners often get tripped up is reading candlestick patterns. These patterns, like the doji, hammer engulfing, shooting star, and morning star, provide clues about market sentiment. For example, a hammer candle after a downtrend suggests potential reversal, while a bearish engulfing pattern near resistance could warn of a pullback. These patterns are more reliable when they occur at significant support/resistance zones or after a prolonged trend. Studying candlestick patterns in context, not in isolation, leads to more accurate interpretations. Reading stock charts also requires understanding gaps when the price opens significantly higher or lower than the previous close, leaving a visible space or gap on the chart. Gaps often occur due to after-hours news, earnings releases, or economic data. There are different types of gaps: common gaps, breakaway gaps, runaway gaps, and exhaustion gaps, each carrying different implications for future price movement. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.